Hello, good evening. Am I audible?
Yes, sir, you're audible.
Yes, sir, you are audible.
Likewise, audio check Joel Pannikot as well.
Yes, sir.
You're audible, Mr. Joel.
Thank you so much.
Second check, am I audible? Second check, am I audible?
Yes, sir, you're audible.
Okay, thank you. Shall we start?
Sita, ma'am.
Yes, ma'am. Please start.
Good evening to one and all from the Faculty Research Cell, Samshodhana, School of Commerce, deemed to be University, Bangalore, in association with the Stock Market Institute, Bangalore. General instructions to participants. Participants need to be present for the entire session. Participants can post their queries on the chat box by the end of the session. A feedback form will be shared during the session on the chat box on Zoom and in the description on YouTube by the end of the panel discussion. I now request the technical team to play a short AV on the 5-day Global Summit. Sharmila, ma'am.
Yes, ma'am, you can go ahead.
Ma'am, can you please play the AV? In the meanwhile, just to give you a gist about day 4 of the Global Summit, there were research paper presentations on various finance topics. Thank you, technical team. Just to give you a brief gist about day 4 of the Global Summit, there were research paper presentations on various finance topics, and there were a good number of papers presented. A very hearty welcome to all of you once again to the last day of the Global Summit on behalf of the Faculty Research Cell Samshodhana, School of Commerce, Jain deemed to be University, Bangalore, in association with the Stock Market Institute, Bangalore. Hearty welcome to all of you once again. I would extend a warm welcome to Mr. Kiran Bindu, Professor of Finance at ISBR, Mr. Firoz Aziz, Deputy CEO, Anand Rathi Private Wealth Management, Member BFSI Community and TEDx Speaker, Mr. Joel Panikot, Head, Asia Pacific at CMT Association, Mr. Kapil Dev, Chief Business Officer, NCDEX, Mr. Shivam Nayak, Founder, El Rezofin, IIM Kozhikode. Without any further delay, let's begin this evening with the panel discussion. I now request Dr. Juhi Jain, Assistant Professor, School of Commerce, Jain deemed to be University, to introduce the moderator for the session, Mr. Kiran Bindu.
Mr. Kiran Bindu is a professor of finance at ISBR, which is a leading graduate school of business accredited by AICTE, NBA, and AIU. He has domain expertise in finance. His areas of interest is financial derivatives, corporate valuation, risk management, and recently GST. Starting in 1995, Mr. Kiran has experience in accounting and auditing areas too. He is a principal in Milan Capital, which focuses on advisory in ESOP and M&A transaction advisory. His past corporate credentials include companies like Indus League Clothing Limited, MCS Software Consulting, and System Domain. He had delivered corporate training in finance in Oracle, HP, Northern Trust, and Symbol Technologies. Between 2013 to 2016, as a mentor at a leading accelerator called Kiran, he has guided the financial projections and valuation effort of over a dozen promising tech startups. Since 2002, Mr. Kiran Bindu has taught in several B schools in Bangalore, including Christ University, Alliance Business Academy, National School of Business, IBS Bangalore, Symbiosis, and MIMS, Wellinkers, PS College, Indus Business Academy, Jain, deemed to be University, Dayanand Sagar University, and many more. I now invite Mr. Kiran Bindu to take over panel discussion.
Thank you so much. I extend a very warm welcome to over 200 plus participants. Let me just have a quick round of introduction with starting from Mr. Kapil Dev, who's the Chief Business Officer of the NCBEX. So he's our commodities guiding force today. He comes with a career spanning 14 years of experience in Indian commodities market. He has introduced a lot of innovation in business operations there. And he has previously worked with Shriram Fertilizers and Chemicals, Monsanto India Limited. He's an agricultural graduate from Pantnagar University, and he holds an MBA in agriculture from Rajasthan University. That is Mr. Kapil Dev for you. And our next panelist is Shivam Nayak, who is joining us from New York. He has over 10 years of experience in banking at Citibank. He has co-founded a fintech startup called RazorFin, where he's a chief product manager. And at Citi, he managed a trade book of over $1.5 billion and cash and securities products of revenues of more than 10 million. At his startup, he has developed a fintech using full stack technologies. He has trained over 500 leaders across Citi, and he has a MBA from Kozhikode IIM, and he's a gold medal too. Joel Panikot is head of Asia Pacific at CTM Association through industry partnerships, educational programming, and brand promotion. Joel, our third panelist of the day, is working to advance the discipline of technical analysis. He has spent over 20 years across various sectors of education technology industry. He has led 3 EdTech startups in this time. Currently, he is the APAC head of CMT Associates and founder of PeakU. And his work uncovers learning synergies between industry, academia, and non-profit sectors. And from 2010 to 2017, Joel was with Bloomberg Asia Pacific Education Strategy, which is, all of you know, is the world's largest support platform for government and corporations. And last but not the very least, Mr. Fizoz Aziz is going to join us. He is the Deputy Chief Executive Officer of Anand Rathi Wealth Management, and he manages their business in over 12 locations with asset under management of exceeding 32,000 crores and with over 60,000 crores of assets under advisory. Mr. Firoz comes in with 18 years of experience in banking and finance industry. He's one of the top private bankers in the country with few thousand crores of assets under his advice for large families and senior management professionals. He routinely makes an appearance on business channels such as CNBC. He was in the 40 under 40 list in 2019. He's also a TEDx speaker. And in 2020, he received the Most Innovate Leader Award by World Congress Leadership and Awards. So it is truly an honor to be here to ask a few questions to all of these luminaries. And we hope that it is going to be a great learning session for all of you, and you will quickly develop your own views on the global financial markets and how it is evolving. So without further delay, let me just open up the free-flowing conversation rather to anyone who wants to kind of take it and run with it. So my first question is going to be with regards to let's get the ball rolling quite smoothly. With American inflation being what it is, interest rates being what it is, and the talk of inverted yield curve, the Ukraine and the oil prices being an overhang, what do we expect to happen in the next few months, both in financial markets and in commodities market and with the startup funding world? Anybody can jump in and then take it forward. So what do you see happening in the short run with all of these overhangs? Kapil, you want to go first?
Yes, thank you. And very good evening to all of you. I think a very interesting time we look forward, because one thing is for sure that market is going to remain very volatile and going to have a the risky, irrespective of the direction it may take. Right? If I talk about commodities market, especially because right now what we are talking about is the energy and its impact on the financial market and inflation, of course, what you have added. I think these two things are worrisome at this point of time. If I start from the food security, it's going to be a huge concern. We have seen sharp jump in all the prices of almost 30 to 40%. And the extreme volatility, this price jump is one part, but the volatility which we have seen is, I think, we haven't observed after 2008, maybe you can say. So that is a very difficult time for inflation point of view, food security point of view, and secondly, of course, is the energy. So going forward, and over and above that, what we have seen in last few months, the prices of nickel, prices of, we know this is a case study now, and prices of all the metals are trading at lifetime high. The wheat prices are almost 40% up. I think this has created a lot of issues as far as supply chains are considered, as far as futures food security is considered, and in long term, this is going to definitely impact the entire ecosystem. And the sentiments are definitely impacted. How do we see markets behaving and how the reports and the discussions are happening? So I do see this will have a long-term impact. It's too early to say what would happen because of Russia and Ukraine, but I think the direction which we are moving is going to be very, very volatile, and we may see quite a surprised price movement in various asset class, starting from commodities. So that's how I do see market going forward, Kiran. Thank you.
Okay. What about you, Mr. Shivam? How do you see the funding for the limited partners are going to be tight-fisted? Are they going to get more risk covers? And consequently, will that have a blowback on the amount of funding available to the VC industry?
I have taking a view back, sort of pulling back, and the last maybe 3 years, you've had sort of three very strong pushes from the government. One is the backstop QE that the Fed was pushing back here in the US, followed by a lot of these COVID-related payments that went through, and with respect to a lot of fiscal stimuluses that have come through. You've actually seen a lot of liquidity come into the market, and that has resulted in a huge amount of capital flowing into capital markets, more than the regular main street. So what was the expectation of a lot of these backstops or a lot of these fiscal stimuluses was to ensure money in the hands of consumers to spend. But what it has resulted in, one of the fascinating data points that I see is a lot of this money, which was sort of has funneled, the COVID payments have funneled into Robin Hoods of the world today, which is effectively the capital markets. And this has sort of given a huge amount of liquidity boost to the VC world, to the PE world, to sort of ensure that they can go ahead and do these large ticket items. But where inflation is right now, I do feel a lot of stances, especially a lot of hawkish views taken by regulators on inflation, to sort of tame that beast. Like, we've never seen 7% inflation here in the US for a pretty long time. Like, I think last it was at this level in 1970s, and we've seen post that. So I do feel the squeeze in liquidity coming in pretty soon. What really worries me, or in general the whole ecosystem, is that people feel that this squeeze in liquidity will be very sudden, and that's where I think regulators need to have, or sort of have their hands full to soften the blow in this. But the way inflation is right now at like near all-time highs, I don't see regulators having too much room there, and that will translate into smaller ticket size, lower deals, etc. And that may change, at least for the near term, in terms of what we may see in terms of unicorn turning deals happening.
I think you're on mute, Dr. Kiran. Dr. Kiran, you're still on mute, I think.
Yeah, you are on mute, Dr. Kiran.
I'm so sorry. Joel, would you want to add, chime in on it with the technical perspective? What are the charts telling you? Is it ominous? Do we see some trend reversals happening?
At this point, like Kapil rightly said, we're looking at a time of immense volatility. But then I want to take it forward from the point that Shivam made. There has been, over the past decade, and if I go back to my own experiences, when I entered and began trading in the markets, US inflation rate was in the 2s and 3s. The interest rate environment at that time was you had a Fed rate of about 4.5%, which was after a series of quarterly cycles announced by Al Greenspan in the early 2000s. This is post the dot-com bust. And since then, and post, like as Shiva mentioned, post the subprime crisis, after interest rates were brought down, there has been a lot of liquidity pumped in the markets. And also what's fascinating is that this is a time of volatility, to echo Kapil's point, where you have a lot of retail participation in the markets as well. So while one is not able to, and it would not be prudent for us to try and predict the direction of the markets. What I would look at is, how does it impact the retail investor? So I have always been of the opinion that the capital markets are largely inflated from the perspective of the relative value that they bring to real industry. But in spite of that, you see a lot of participation in the capital markets right now with the Robin Hoods of the world in the US, with discount broking becoming as big a thing as it is in India. My bigger concern would be in this time of volatility, and global volatility now translates across markets much faster than it used to back in my trading days, even 15 or 20 years ago. And so what I think we need to kind of think about is, how can the retail participants protect themselves? And to echo Shivan's point, what does then the responsibility of the regulator become in order to protect the small investor was vis-a-vis the market moves that are precipitated by larger investment houses, the banking and the financial service industry as a whole. So
hold on to that thought. Hold on to that thought. I will just quickly come back to you. My second kind of question is once again starting with the startup world, because they seem to be the flavor of the season, and some of the concerns seems to be that there has been a never-ending flow of kind of underwhelming news insofar as Indian startup world is concerned, with a 70% drop in value of one of the startups that listed recently, to a daily soap opera between two founders of a startup. It looks like a lack of adult supervision is really hurting the startup community in India. Shivam, would you want to just throw some light on the startup management and the corporate governance that permeates in this space, and compare it with your expectation in the US, Shivam?
Yes, it's a very fascinating question that you mentioned, and like you will always where there is money, you will always find buffoons, and you will always see this sort of people who will play to the galleys, and it's not anything new, right? Like it's happened at a different scale in India right now in the last 2-3 years. But I don't know if you remember, there was this company called Housing, and you again had a similar sort of soap opera running with the founder there as well, but at a lesser scale. But what's fascinating is that India is warming up to characters like this. It has been something which is the norm in the West, in terms of you've had people question ethics of founders, people sort of not invest in deals basis ethics, but still companies do well. You've had the WorldCom sort of complete fraud accounting, which was just as big as Enron, if not as maybe not as big as Enron, but as significant as Enron in terms of accounting frauds. But what I feel is that markets in general have shown resilience, and they've sort of they understand that this is a risk. They factor that in. It's unfortunate if you get caught on a wrong side of such a deal, because it comes out pretty episodic. There's no way you can factor it unless other than diversification, on sort of saying that you've taken out the systemic risk or in your portfolio and you do it. But in a large single chunky deal in environment that I sort of operate in, or I sort of work in, where you have significant exposure to a single deal, you have to be more diligent with your sort of due diligence, your background checks, and your follow-up checks, etc. But it will always happen, and markets will show resilience and sort of factor in that at least a few percent of startups will behave like that. Another point that I've also said now is they've sort of observed a trend around activism investment, and that sort of permeated not just in the stock market, it's permeated down right to the PE level, or even I wouldn't say at the startup level, but slightly pre-IPO stages as well, where a lot of
the
options
of the world.
Yes, where people sort of either at a pre-IPO stage decide to take company private, take different directions, etc. And what's that sort of ensured that there will be a lot of collective trust in the system, but it's also put in a lot of power in the hands of few. Like gone are the days where you had to own a significant percentage to be an activist. The moment you own 5%, you can start sort of rallying resources, creating sort of a buzz around it. Short sellers have sort of become more cowboyish right now, I would say. Like, I'm sure Joel would sort of shed more light with his day-to-day. I can see him smiling.
So I think I will just pitch in with my next question. See, all you gentlemen come with tremendous experience in your respective areas, and we have a whole bunch of audience who are students. So what would be that one skill that will enable them to be a successful VC, a successful commodities trader, and a successful technical analyst? If I may start with Joel. Let's go with Joel first. Successful technical analyst. Do you need to go to a certain company? Do you need to do certain courses? Do they need a mentor like you? What would it take to be a successful technical analyst, Joel?
To be a successful technical analyst, one would need to learn technical analysis and learn the discipline with a certain amount of width. There is often this misconception around technical analysis that it is specifically only for traders or only relevant to the short term, whereas true market strategists or market technicians, as we call them globally, operate across all asset classes, across all geographies, and across all time frames because the principles are universal. So learning this in a meaningful, more profound way, and I don't want to use this platform for a self-plug, but taking a look at the CMT knowledge for kind of the program, for instance, is an interesting way to go. But what is more important, I would think about, is the importance of a discipline like technical analysis across anyone who's either facing the markets or facing their customers and talking about the markets, right? So what I would argue for is that technical analysis is no longer just a skill for anyone who's professionally actively involved in trading. But for young students, I can see some 358 names, people attending. For young students, understanding the skill is an inevitability now and a necessity, because if they are going to participate in the market, the least they can do is manage their risk when the markets work against them.
So yeah, there's a huge information value to the charts and what they're trying to tell you and where they are at the moment and what they are likely to do. It kind of summarizes what the market is thinking on any given day at any given point of time. I totally agree with you on that. Shivam, how do you get into a VC industry without having an exit behind you? That is, how do you raise funds from an LP? Would that be something of interest for you to fund, or would you want to go through the tried and tested way of having an exit and then turning out to be a VP? The floor is yours.
So I think let me take a step back and just sort of see what Joel had put across. There is something like, in terms of career in finance, I feel it's not always about following a path. And we've sort of reached a stage where a lot of mentors, a lot of past precedents are not our real heroes anymore. And one amazing example that I sort of tell all my students is that, look at John Grisham, right? As a writer, he would be an average writer. And as a lawyer, he himself says that I never want to practice law. But at that intersection of being a writer who writes about law, he is the bestseller, right? So you have to find that intersection, that space where you would want to operate. It need not be like you want to, like, the tried and tested path could be that you go ahead and you do have an exit, have some money to burn, etc. Start with an angel investing, or either say have your thesis on investing and then start becoming a limited partner in VC. That makes sense. Another route could be you become an entrepreneur in residence with the VC and then sort of migrate into this. But at each core, find what is your multiple intersection points that sort of bring out natural strengths, and that can lead you to a path of success. It need not be that I want to be a VC, I want to be an entrepreneur, right? Even if I take a personal example, right? Having spent an entire career in finance, I decided to start a tech startup because I felt that was natural to me. I still teach Python to finance students because I feel that being at that intersection of finance and Python is a nuanced product that I can sort of bring to this space versus just being in the finance domain where I'm competing with really experienced guys like Joel, Kapil, and everyone. But in a nuanced space where I'm bringing financial knowledge and sort of integrating that with tech on the lending side sort of opens up new doors. So if I had to give one bullet point to any student, find what are your strengths and play to that advantage. And like, there are so many options opening up. The world is not followed by people who have careers, right? It's not going to be a 30-year career anymore. Every 5 years, you need to figure out what's your next gig. And I think within the finance community.
That's deep insight. Welcome, Mr. Feroz. It's lovely to have you here with us this evening. I'll just quickly extend this question to Kapil, and then I will come back to you, Mr. Feroz, for a detailed discussion. Mr. Kapil, how does one get into the commodities trading end of the business? Same question to you.
Yeah. So, actually, when we say commodities trading, it's not a trading. It's, commodities is a economic function for any of the organization, right? It's a raw material for 90%. Most of the industry's raw material contribute 90%, and that's what commodities comes into picture. When we say the commodities trading, right? First, you have to respect the market and accept the price. So most of the time, what happens that we are the market and we have our own price, and that's the point where this entire, um, problem starts.
Okay.
And we start thinking market in a different direction. So that's one. Second, risk management for a commodity trader or maybe procurement manager and handling the supply chain has to be a policy, not the decision, right? It has to be a policy which is well drafted, well defined, and it is being followed at any point of time. The risk management cannot be a decision when to do, when not to do at this volatile time. I think the next one is the filtration of information. Right now, we are flooded with a lot of information, and 90% of them we are the last recipient of that information. So one need to be very, very quick to filter the information, create their own analysis, and when making the trading decisions. And of course, keep on learning and upgrading, because commodities are seasonal. Every year is a new year, impacted by lot many things, but impacts lot many other things as well. So I think that's the last point I would like to mention. And of course, the commodity trading, where you have to go, you have to trade, and then you have to learn. So,
you have to be in the water to learn to swim.
Correct. Yes.
Mr. Firoz, are you there? Good evening, sir.
Can you hear me? I'm there.
Hi, Mr. Firoz.
Hello.
I was absolutely delighted to know that 1,000 debentures linked to market that you have created. It just was super impressive. And then the 8% alpha, how do you manage it? I mean, come on, what is the secret? You have to tell us something at least. How do you manage an 8% alpha? It is like Michael Jordan.
No, it's not such big rocket science. What we live is you dealt with certain cards. You play with them. When you're living in India, there are some benefits you have, right? You are in a relatively higher interest rate economy. That's one advantage you have. The second advantage which you have is the higher volatility. Indian markets have exhibited a higher volatility. With these two raw material or ingredients, if you want to call it, can you generate alpha by combining debt and derivative in certain proportions? In a very methodical fashion? That's what a market limit linked debenture does. If you are not wanting to overly innovate, just focus on these two positives. By operating in the Indian market, you are able to generate that alpha. What am I trying to say is, because debt already gives you 7-8%, today there was an RBI policy which moved the 10-year GSEC above 7%. If you want to make 14, 15, 16%, if you can secure the first 7-8, derivative can give you that little icing on the cake to get you to 15, 16%, 17% as well. And if Nifty delivered 10, 11 over the long periods, then you can get to 16, 17. That's where the alpha comes from. To be honest, it's not been such a rocket science. It's just that we all as Indians have certain merits to operate in an economy like this. You just capitalize on those and keep risk into mind and mix derivatives in very calibrated proportions so that you're not going overboard. Derivatives could be fire, so you can light up your stove with it, or you can bring down the house. So it's about the proportions and the calibration, which has resulted in this output.
Mr. Firoz, I'm going to push you further.
Yes, sir.
Tell me, sir, how can I replicate your portfolio if I have 100 rupees? Let us lift the hood of the car now.
Okay, now I'll have to get very technical if I have to answer that. Pardon me if I do. So what happens is, let's assume if you have 100 rupees, you put all the 100 rupees in debt.
Okay.
If you put all of the 100 rupees in debt, obviously you're not going to make 14, 15, 16%. You're going to make 7-8%. That's the next obvious question would be, how would you get the differential? You also operate in a country where over the last 10, 12 years, you've had long dated options. So if you sell a 3-year put option by providing this debt as margin on NSE platform, if you sold a 3-year put option, which are also called LEAPs, LEAPS, long dated equity participation securities. If you sell a put, you get a premium. Let's assume you get a premium of 12 rupees, 14 rupees by selling 1.5 times the put. If you sold those puts and you combined it with debt, if the market went up a few percentage points, the put premium becomes zero. So you have got a premium, you've collected the premium today, that premium becomes yours to keep. So you have 100 rupees plus the premium, and the growth of this 112 rupees results in a return. This is the conceptual idea. There are levels of moving it to the second level, third level, but that's the basic
Let me repeat it back to you so that I have understood it properly. So I have 100 rupees, I put it in FD, and then I use that FD as a collateral, and I write long dated put options, which is basically an insurance policy. And these put options are written on the Nifty,
Absolutely.
which gets excised if the market were to crash. Then they would all come looking for you. But so long as the market does not crash and the market goes up, you're safe, because
Absolutely.
the option is never going to get excised and the 12 rupees is yours. Have I understood you correctly?
Precisely. Now, let me just add one point. When these guys coming looking for you, if the option gets exercised, you will still have a protection for the first 20-30%, because your 112 rupees grew to, let's assume, 150 in 3 years. If the market is down 20%, you will have to pay 20% to the put option guy. If you have sold 2 puts, you have to give away 40%. You have 150, you pay 40, you're still left with 110. Even if the market is down 25%, you will still have your capital back. That's how you generate that.
Awesome. Simply phenomenal. I was so excited to kind of pick your brains on how are you managing this, and it was a wonderful learning for me, and I'm sure it was for students. So I'm sure Shivam, Kapil, and Joel would equally be excited about your coming in. Now, I have a question for all of you. Anybody can jump in. It may be a little underwhelming question, but I have to ask it. Recently, we have heard about a spate of, once again, the dreaded accounting issues propping up with companies that were manufacturing two-wheelers. And there was an accounting issue, and they bumped up the expenses so that the managing director could buy a farmhouse. You think we have lived far enough to kind of put up with this kind of an accounting distortion? Should something really need to be done? And people like you all who have the kind of ear of the powers that be should kind of be more forceful in telling that, listen, it is 2022, we can no longer accept these kind of accounting shenanigans. Anybody can jump in with their response first, please. Go ahead. Yeah, go ahead, Mr. Feroz. Go ahead.
Okay, if you want me to answer that. Of course, accounting standards in India have to be better. The governance has to improve. But as we investors or traders have one choice to identify those businesses which can not give you such surprises. So thankfully, finance is a very well-researched subject. There are different scores which are available. The C score, the Z score, which tells you whether the company has been innovative in terms of accounting, and you would stay away from a certain companies. So doing homeworks of creating those formulas which have been created, which help you understand whether the business is doing accounting innovation to prep up the balance sheets are possible. So that's what we use. And now, for example, if you're measuring the credit risk of a company using the balance sheet, Z scores, Altman Z scores become a very strong tool to ascertain the second decimal probability of a company going bankrupt. Like credit ratings have disappointed us because several companies which went bankrupt were AAA just a day before they went default. AAA to D straight away. So Altman Z-score, for example, has predicted defaults significantly better than any rating agency in the country or globally as well. So what we can do is wait for things to change or take the matter in your own hand and get on the driving seat and identify those businesses which are best avoided.
Shivam, would you agree with that? Because Enron's bonds collapsed long before the company went bankrupt. I remember way back in 2003. What is your perspective in the US, Shivam, about creative accounting? Does it still happen post the Sarbanes-Oxley era?
It does, and I think Feroz very validly touches upon that you don't need to always look at the standards, what is the norm in the market, look at alternative scores, do thorough with your due diligence. In a space like mine, in a space like mine, where you do go ahead and do a larger ticket size, you have lesser scope for diversification. Due diligence, doing foot on ground has no substitute. You cannot depend on, say, a lawyer or an auditor's report to just come through. Like I remember I was working with Ruan Kanif and Goldfarb, and one of their investment managers actually came to India, and we were their custodians back in City back then. And he would visit actual on-ground factories in Orissa and in Jharkhand to decide whether he needs to invest or not. So that amount of due diligence on ground, on foot, is needed for you to be sure about what those investments happen.
Okay.
On a broader perspective, sorry, just one point. On a broader perspective, I feel like the green sills, the world comps will happen, and you've sort of got to roll with the markets. But I feel time and again, markets have shown resilience to sort of overcome these norms. There've always been motions that something needs to be done, but what is always the million-dollar question.
Joel, have you in your experience come across a disconnect between the charts and what the companies are telling in an analyst meet? They are going all gung-ho about their future prospects, but the charts are just not interested in what they're saying. Have you ever seen that in your career?
Ever so often, in fact. So even before I worked with the CMT Association, during my time at Bloomberg, we used to have this running joke about what analysts say about stocks and what the stocks are actually doing in the markets. And Professor Ashwath Damodaran actually phrases this very well. It's about technical analysis being a tool to navigate the gap between intrinsic value and market price, right? And so I actually wanted to touch upon the previous question that we were talking about as well, about in a world where fraud is not just highly likely, it's inevitable over a larger period of time. As long as human beings are dealing with in the markets, and we are humans, we will be greedy and we will be fearful, and there will inevitably be instances of fraud. My thoughts go on, yes, one, I definitely echo Feroz's point too. While looking at credit reports, also looking at quantitative models that are able to bypass what credit reports are telling us and give us more meaningful insights. The Altman Z-score, for instance, the default risk tool on the Bloomberg terminal is another example that we used to use quite often of.
You all see that credit default swap points on Russia? It is going through the roof.
These are all perception driven. What I would often talk to, and I even now as part of my work talk to both professional fund managers and retail investors, is what do you do when these instances do happen? Because inevitably, and the next big bust or the next big disclosure of some kind of quote unquote creative accounting will happen from a place where you do not expect it. Who thought Lehman Brothers would fail? But what do you do when it does happen? How do you manage your market risk, your market exposure when it does happen? I think a bigger question that market participants need to focus on. We could philosophize all the livelong day about why such things happen, but what do you do when you are invested in the market and you have to react to a situation? And that is really where that often forms the crux of my conversation. My investment management approach also comes from this perspective. Inevitably, the market will do what it does. And instead of thinking of it from the lens of prediction and trying to decide where the market will go, can I react to the markets as they are unfolding? Whether it is looking at trading from a momentum lens, following a stock as it trends in a certain direction and knowing when to get out of the way is probably as important as trying to figure out the intrinsic value of the moral fiber of the founders and accountants.
Absolutely. Yeah, absolutely. But Kapil, you don't deal with all of these issues, right? Commodities. I mean, everybody needs the industrial metal and the precious metals. So long as there is no production bottleneck or no ship standing in an angle in Suez Canal, all is good in commodities market, right?
I wish it was like what you are saying.
I'm joking.
But the commodities are now much more talked at financial market and daily market. We do see what's happening in the commodities, and we take some clue what may happen in the financial market, how the inflation is going to be, right? And as I said, commodities last 2 years have remained unprecedented, right? We have seen a commodities going into negative territory, right, within a day. And now we have seen commodities getting double and even more than double within a day. And that has busted many of the risk management theories, right? And I think the best learning here, whether it's the financial thing, whether these kind of event, that how proactive we are to manage these kind of situations, right? So as I mentioned earlier, risk management cannot be one day decision. It has to be a policy. And in 99% cases, whether it's for exchange, whether it's from broker, whether it's the bank, the risk management is a one-day event, right? We have all the risk management policies which is being tested on day one. I think for us, like exchange space have also seen, especially for commodities, this, and we have been very stressed on this aspect because in a leveraged market, when you have 5-6% margin and prices move beyond 20%, 30%, and maybe 100% overnight, the entire risk management goes on a toss, and then the confidence of the market becomes very difficult, right, to get it back again. And that's what we have seen multiple times. We have seen various events that happening. Maybe that has led all the exchanges and the regulators to a maybe a deep thinking that do we need means how to judge the market with a lot of volume, with a lot of leverage, or maybe a little more strengthened risk management and lesser volume and lesser the limits. I think that's the direction we are talking about. More the leverage market is good. We have seen the market which is being grown. Firoj has talked about options. We have seen what options has done to Indian financial market, but it leads a lot of challenges and it brings a lot of stress to the risk management of exchange and the brokers, I think, and that we have seen in last few years, some things, a lot happening on that thing. So I think from the exchange perspective, we do see a lot of risk framework need to be upgraded, and maybe a traditional approach, the leverage over leverage and leverage over leverage need to be recalculated, and we have to get our system ready to avoid these kind of incident. I think normal trading doesn't, a daily 4%, 5% price movement doesn't need now that kind of risk management what we look for from the exchange. I think the expectation from the market also that exchange should be capable and the market should be capable to manage 50%, 60% kind of intraday movement. So I think that is what we are talking. We have seen a lot of things from the regulatory side. If you see the peak margin is now applicable, derivatives are not leverage and over leverage, and the margin, the framework have changed a lot. If you see the commodities which were trading average 6% margin few years back, now the average margin in the Indian derivative market in commodities specifically is 20-30%. Right? So that's the change this volatility bringing to the risk management and the compliance of the exchanges itself. And coming to your main question, which do we face these issues? Yes, we do face, because commodities are always sensitive, and these are seasonal commodities. The stocks are always an issue. Prices are controlled in many ways, especially in the Indian market, and both ways these have their own sensitivity. Agriculture commodities prices goes down, then farmers are impacted, prices goes up, then the consumers are impacted, and various policies, knee-jerk reaction, policy shock, we keep on seeing market kept on seeing, and I think it will continue for some more time looking at current market conditions. So it's challenging, but at the end, it is important that how reactive and proactive you are and how your strategy is capable to manage these kind of shocks. So if you have that in place, I don't think it's as much challenging for the market participants.
Okay, I have one question for all of you. It is a uniform question. What is that one, in the case of Jewel, chart pattern, in case of Mr. Kapil, that one commodity in the case of Mr. Firoz, that one news, and Shivam, that one information that keeps you awake at night, which is Armageddon scenario. One chart pattern, Mr. Jewel, one commodity that.
I hear where you're coming from, Professor Kiran, but I don't know that there is a single element to anything in the market that's as complex as this. I would pay attention to the general direction of markets. I would want to not see excessive volatility in the markets, but that's a personality thing. What keeps me awake is what is happening to perhaps my equity curve. And that is a result of the risk management that I have put in. So is the market within the range of the risk parameters that I have set for it, or do I have to rework my strategy and get out of whatever it is that I'm invested in? Would be where I'm likely to lose sleep at all. So it would not be a single event or a pattern. It would certainly be how is a trade or how is investment performing within the risk parameters that I believe are reasonable for me based on my investment style.
Okay. How about you, Mr. Shivam? As an investor in a startup, what is that one thing that economic event, that news from the markets that kind of keeps you up at night?
So operating in this space, I don't think anything keeps me up at night because it's not as dynamic as the real-time markets. You have time to unwind your trades. You have time to course correct. You have time to catch mistakes. But what in general worries me about investing is betting on the right team. Like, have we bet on the right team? Is the founder resilient enough to continue through thick and thin? Because at the end of the day, it is the founders that's going to help you create value and help you create 100x returns. Any amount of financial engineering, any amount of investment, any amount of pricing your investment right will not make that change. So it's always like, and however good you can be, being a judge of a human character is the hardest thing. So I think just doing that right and just trying to be confident that you've made the right decisions is something that I would always worry about. Look for symptoms, look for small changes, look for trigger points. But other than that, I would say nothing else in this space.
Mr. Firoz.
So from an investing standpoint, it doesn't keep me awake, but that's what we would be very vigilant about would be the earnings. See, what happens is if you are able to go item by item, constituent by constituent, calculating the possible earnings, you will be ahead of the curve. What happens is most people would not know the Nifty projected earnings. Now this year, what's the earning closure? Is it 650, 700 for Nifty? People wouldn't be aware, but they would be investing in equity. So like August 2020, we saw very, very strong early signs of earnings revival. So we went very bullish on equity, whereas the world was very worried about the pandemic and its what shape it would take. So being aware of earnings, see, it's very easy to predict earnings for a Nifty, for example, like 3 companies constitute almost about 28-29% weightage. So if you are trying to understand those businesses in deeper detail, you get the earnings right. Why is that important? Now, for example, next year, earning projections are 820 for Nifty. So that helps you understand the fundamental value of Nifty. So when Nifty touched 18,000, we knew that the fundamental value substantiatable was 16,600. So you go slower at 18,000. When you get 16,000 levels, then you have the courage to put in your money, which you're sitting in this, if you're sitting on the fence, because you know 16,600 is the pivot. So it helps you make your allocations at the right time, one. Second is, it's very important to never get too fancy, in our opinion, with the base of the cake. I'll draw up an analogy. Like you eat the tastiest cake or the one which you didn't like, the base is same. So you create a very strong foundation, and then you put layers of efficiency on top of it. And we don't believe in wanting to do 30% return, 40% return, because compounding really comes in your favor if you have consistency as the theme rather than exorbitant returns as your pursuit. So we like to pursue 14-15% return, but more consistently.
Yeah, I mean, 30, 40 minus 90 plus 100 does not make much sense, because that minus 90 is going to knock off your the capital that you have. So if I've understood you correctly, what was I? Yeah, so you have the earnings projection, and then you divide that by the current level of the Nifty to arrive at a quotient. And what is that quotient for you?
See, we look at what happens is now forward P's for the last 21 years, the average forward P implied has been 18. But P's have a very strong correlation to interest rates. Lower the interest rate, higher is the P substantiatable. So what happens is you normalize the average 18 forward P to interest rates. Then the fundamental average P could be as much as 21. So 21 times 800, for example, becomes your pivot. Helps you derive a strategy whether you're going to stagger your money or you're going to go more in debt, more in equity. So normalizing P, average P 18 to interest rates makes 21 a justifiable P today, given the lower interest rates, which seem to be continuing with the accommodative stance, which RBI reiterated today.
Excellent. I think we have a little bit of time for questions. I think we should allow the students who have been listening so patiently to kind of come up with some questions. Are there any questions in the chat box? We would be happy to address it. We have to wind up at 6:30, 7:30 rather. Please feel free to ask questions. We are all friends here having a candid chat. Go ahead. Faculties, students, please address your question in the chat box and I will read it out. Okay, we don't seem to have any questions. Fair enough. I think we will probably continue to talk a little bit. What should universities do? Okay. How to control frauds? I think we have spoken a little bit about frauds. So I think it's going to be a bit of a repetition. So if you would, anyone would want to quickly answer that question. The frauds and functions of corporates are the thing going to continue in the future. The HLF and rating is an example how to control this. Anybody quickly? 20 seconds.
You want me to take that?
Yeah, anyone can jump in. Yeah, please go ahead.
Yeah, so I think you have to, you can't visualize a perfect world. It's about the frequency of such instances. Has that gone down? Dramatically, it has. So be a little more positive. As a youngster in the investing world, pessimism is the most expensive trait. If you're very pessimistic, you're going to miss out. Optimism creates value. So I would always insist youngsters to not see it with a skepticism and look at the frequency and the kind of maturity our market has gone through. Today, our volumes are so large. Earlier, it was not just the corporate or the promoter which could do something which is fraudulent. Market participants could create a lot of fraudulent practices. That is behind us. So you are, as youngsters, going to be entering into a capital market which is far, far, far more cleaner. But if you're assuming that there's going to be no fraud, no instance which you can remember, the answer is no. Even 100 years from now, you will still have those instances. So don't wait for a clean super clean corporate governance. You just have to look at it that we are miles ahead than where we were, and be positive and try and be vigilant to see which part of the capital market would you capitalize to create value for yourselves or your clients or whoever, whatever nature of work you indulge into.
I'll echo
Shivam, this next question
here.
is for you. Sorry, Joel, 1 second. I'll just come back to you. Shivam, how big is ESG factor in the US? Is it really caught on or is it a fad? ESG.
So just to give, sorry, not to blow my own trumpet, like we've just started a new company, provide ESG data in Europe. So while in US, it is still lagging behind Europe, but in Europe, it is something which is a must-have anymore. But the way I see ESG playing out is that ESG will not impact the share price like how the question has put out. It would be a deciding factor in capital allocation. Like, do you invest money in companies which do not have high ESG scores? So it will impact capital allocation, and then obviously it's an evolving curve with the amount of information that comes through, and people will also get that. So yeah, sorry, Joel had something to add.
I was just kind of adding to the previous question that we can't do much to control what is happening in the financial markets. What we can control is ourselves. It kind of ties back to the ideas of trading psychology, of managing ourselves within this ecosystem where almost everything is unpredictable, and while I wouldn't say unknowable, it is not easily accessible to everyone. What we can control is ourselves and our investment performance, our investment management. So that's really for the young folks on the call. Like Feroz said, don't be pessimistic about the world. The world is quite a nice place. What you need to be careful about, though, is how you are managing yourself within that. Behavioral psychology says cognitive biases are an innately human trait. How you can navigate those and manage your investments beyond that is really what you need to focus on. So Kiran, you're on mute better.
Mr. Kiran, you are on mute.
I'm so sorry. I got thrown out again. Would you, Joel, answer the last question, which is regard to volatility in the market? How do you get to know about the volatility in the market? I would imagine VIX would be the way to go. Anything else that you would want to?
VIX is one way to look at the market. It's kind of a more available index. A lot of data providers create their own calculations and models of implied volatility as well. Most banks, this is a lot of data that is calculated and sold by a lot of firms as well. So that's something. And then, of course, understanding from a market technician's perspective, the behavior on the chart tells you a lot about volatility as well. You can see very easily what tendencies a certain security price shows over time, and that gives you a very simple sense. How do you cope with this volatility? Again, understanding this, having a risk management process, understanding your investment management process within this is usually a meaningful way to do that.
Okay, now the questions are coming thick and fast.
Can I add on that VIX question?
Yeah, go ahead.
See, what happens is implied volatility, especially like VIX is very popular from an Indian context on Nifty, but that uses near-term volatility of the near-term options of that month, right? So implied volatility of different periods can be found out. So now today, if you're trying to find out VIX for India, Indian Nifty as an index, then you have the 1 month VIX, which is computed and thrown up. But you can also find out the implied volatility of 1 year, which has also become liquid. You can also get 3 year. So there are some agencies which consolidate the implied volatilities of all market participants. One such agency is Totem. Totem actually takes all the Nifty traders as per the weightages of their open interest and gives you an implied volatility aggregated by all market participants.
Oh, that's really rocket science. Okay, that's valuable information. So there are some more questions. One commodity related question: is gold still investable or people have to explore other commodities for investments? Is gold still investable, or people have to explore other commodities for investments? Sir Kapil, this is for you. This is right up your alley.
No, I think investment is the personal choice, but I would like to say that there are new tools, instruments are coming to the commodities market as well. It's not the plain vanilla futures market. We have options trading actively now growing. We have index commodity indices are coming in. So new avenues are being created, and gold, of course, has always is the priority as far as commodities is being concerned, or it has the fancy of the investor. But I think there are now multiple options available as far as commodities are concerned, and depending on the individual choice and the goal of the investment, other commodities can be explored. Right? I think in Indian market, if you look on all the parameters, which is the most successful futures contract, it's not gold actually, it's natural gas and crude. So we have to see, and there are other commodities which are getting those kind of attraction of the investors, and I think gold has its own charm, but there are a lot of new commodities and instruments being added to the commodities list.
All right. So banking stocks which are going down, will there be a problem to real estate, automobile, which have partnered and have loan system with their customers? Anyone? Firoz, would you want to please answer that question?
The answer to that is, the answer is no. Will real estate companies and automobile have an impact because of stock prices of the banking stocks? The answer is no. Because if you partner with somebody, your partnership is to help your client as a real estate firm borrow from a bank. What will concern, if I was a real estate developer, what will concern is what is the rate at which my client who's going to buy a home from me borrow from the bank. Since RBI is keeping the repo rate lower, using other innovative methods to calibrate liquidity, the interest rates today at home loan interest rates are at 6.5%, which is the least over the last decade and a half. We have also seen 9.5% in the previous decade, and today it's at 6.5%. In spite of inflation being at 6 in January, you have 6.5 being the home loan rate. In fact, the irony or the surprising part is you as an individual are able to borrow less than Government of India. Government of India's 10-year paper today closed at 7.1%. Home loan rates are at 6.5%. This negative spread between government and individual is a unique thing. So point is, stocks might go down, but individuals today are able to borrow in India at far better rates than even corporates are able to borrow on a 10-year basis.
Amazing times we live in. They want to give a boost to the home ownership, I suppose. There are a few more questions in the chat box. Everyone is heading towards crypto. What is your say about it? And this is directly addressed to you, Mr. Firoz.
Yes. So when it comes to crypto, of course, people call it the new gold, the digital gold. I think it is not an investment instrument at all. It could be a trader's delight. I would love to synthesize a put option on a Bitcoin, which will have a 40% value. What I mean by that is, first point is it's not established itself as a currency, because currency's key attribute should be stability. In the last 1 year, it has moved more than 10% in a day 17 times. It has moved more than 5% a day 65 times. Nifty has not even moved one such day you've not found. It has moved more than 3% in a day 126 times. That's the kind of standard deviation. The standard deviation of crypto is 72%. So can it ever be called a currency? Currencies are supposed to be stable. So it doesn't fit as a currency. It doesn't fit as an asset because it does not create inherent value, right? So like when you buy an Infosys share, for example, lakhs of people are going to work to create value. What it can definitely be is a super trading instrument because of its high 72% volatility with large volumes. So when you get into crypto, and that's the safest crypto I'm speaking about, Bitcoin, the largest market cap crypto I'm speaking about, and that's the kind of volatility it throws up. People jump into it without knowing the kind of standard deviation it throws up. So if you actually synthesize a put on this, you will get 45% for a 1-year put. So I would rather put money in an FD, sell the put, How do you synthesize put? It's a large subject in itself. If you Googled it, you will know it's not a listed put. Futures are there on crypto, and that's good enough to synthesize a put. So point is, youngsters should be aware that just jumping into crypto without understanding its risks is not a great idea. And if the return for all this volatility, the return is minus 3% over the last 1 year, would I ever, if I put it on the capital asset pricing model, it will be the farthest from the efficiency frontier.
Very true. I'm so delighted to hear my market professional talk about efficient frontier curve. I'm tired of people saying it's all theory, and I tell them that no, Harry Markowitz did a great job of actually telling us how risk and return trade-off occurs. So the next one is US is currently in the midst of printing currency notes. Will it affect its market? Mr. Shivam, your perspective on this, please. US is printing currency notes. Will it in any way affect the markets?
So how is that any different from the QE backstop that it does, right? So like the effect that it offers liquidity, the effect that it offers in terms of being the reserve currency of the world will have impact. However, what's more troubling or sort of a long-term view that is sort of impacting is that a lot of countries have noted how US has weaponized the financial system. And that is a stronger sort of, even if it's a smaller indicator right now, is a stronger indicator for me to look at how we would end up into a multipolar or a multi power centers in terms of the financial markets. And then the printing ability of the US dollar would have a lesser impact. But till the time it remains the primary source of the reserves, it will have any impact similar to the QEs that it has. It's the only currency where you can print and still not lose value.
Absolutely. I mean, they enjoy a unique position in the global economy. They can afford to print currency and still they will enjoy a very high credit rating because of just the historical things that have happened there. Whether debt or equity finance is beneficial to wealth creation of a firm and also to investors. Among two sources of finance, which is the best? Okay, whether debt or equity finance is beneficial to wealth creation of a firm and also to investors. Among two sources of finance, which is the best? Can I quickly answer that? Well, most of the American banks are heavily leveraged, and the subprime mortgage crisis, you had leverage levels of 33:1. So a tiny drop in the value of the assets would essentially make you technically bankrupt. So historically, people have leveraged a lot over their tiny slice of equity to borrow a lot of money on top of that and to invest in various asset classes. Your BlackRock, one of the world's biggest private equity, which is at $14 trillion, does that all day long. They borrow money and then they invest. They turn around the nature of the obligation because they are BlackRock, they can afford to do that. And ILFS tried to do the same thing, what BlackRock did, and they ended up with egg on their face and they had to be bailed out. So yes, debt is very attractive because it is now available in Switzerland at less than 1%, at least a short-term debt, before it jumped up, spiked up. So yes, depending on what business you are in, debt or equity is your choice. Just that don't borrow money and do a very risky business like putting a train below the English Channel, because then you have risk on both the sides. The business is also risky. The market acceptance of the business is risky. And on top of that, you have a $4 billion debt that you have to service. That's going to be a killer for you. I think that I've answered that. That's out of the way. So the next one, the panelists are going to answer. Apart from traditional investment, any alternative investment avenues available to retail investors? This is a beautiful question. Apart from traditional investment, any alternative investment avenue available to retail investors? Go ahead, please. Anybody can take it. Apart from traditional investment, any alternative investment avenue available for retail investors? I think the only thing that comes to my mind is REIT. You can invest in Embassy's REIT, and that's the closest you will ever get to holding a large piece of real estate indirectly. REIT and InvIT are the only things that comes to my mind. Anything else comes to the mind of the panelists, can please shed some light on that.
Yes, there are. There's several which are there. Like, of course, like you mentioned, REITs are there. So any alternate product which you look at, like REIT, you would pass it through a test, a six filter test. If it passes through, then it becomes a part of your portfolio. From academic interest perspective, there are several. What's currently happening is the unlisted space. The unlisted space, people are able to buy stocks in very, very small lot sizes before they get listed. So there are several firms which have come up, which act as intermediaries to house those unlisted stocks. So today, if you want to buy, IPL season is on. If you want to buy stocks of CSK, there are platforms available. You can buy that stock. Farm Easy, before it's filed its IPO, it's got delayed. People are selling and buying shares worth 20,000 rupees, if that's called retail. So unlisted stocks is something, but it's an unregulated space, not as well regulated space. I would not call it unregulated, but that's one thing which is emerging. People have burned their fingers as well, but there's enough excitement which currently happens there. Third is, if you look at it, there is a lot of co-ownership ideas which have come, especially on the real estate side. There are Bangalore-based couple of firms which help you co-own a certain real estate piece. So all these are there, but before you put your money, you have to ask one question: what's your objective? If your objective is 20% per annum compounded for the next 20 years, 10 years, then you need to do fancy stuff. If you're quenching your thirst with 15, 16%, you don't need to do fancy stuff. Operate at LCM rather than HCF, least common multiple, which is the simplest way to achieve my objective, which is the most fulfilling, satisfying way, right? It is more satisfying to get something new, right? That's what we tell our clients, saying that you don't have to look for interesting things, right? Investment is not entertainment. If you can get yourself 15% with a simplistic strategy, use that, unless your objectives are redefined to 20-25% compounded returns.
Sorry.
Yeah, go ahead, Mr. Kapil. Go ahead, Mr. Kapil.
So because we have all the students, and I would say depend. Traditional and the new depends where you are at this point of time, right? India as a country, we are a traditional investor. We now in last 1 year we are talking about 7 crore of account getting opened up. Otherwise, it was only 2.5 and 3 crore, right? So I think the diversification, I think, is the best way to discuss the new avenue for investment rather than traditional. As a country, we have remained a traditional this thing, even in the existing system, apart from bank savings and other regular instruments. Now we are moving towards the fund. The growth mutual funds have seen is tremendous. And even the mutual funds, there are various kind of funds which are available, debt fund. Now we have commodities fund. Now we are talking about crypto. So I think the new avenue always depends where you are at this point of time. But yes, market have a lot of new tools and new avenue where you can go and get invested. But yes, and the last point is you need to get your goal very clear, what you want to get from the market, and maybe then you'll be in a better position to decide where to go and where to move on. Otherwise, Firoz definitely is there to keep on helping the people where to go and put the money.
Just one point here, I think, in terms of US, two asset classes have become really popular in alternative category. One is art, a lot of co-ownerships on art that have sort of become. And the second asset class is with sort of securitization of SaaS revenues. They've sort of come back and said that SaaS revenues in US is so stable that you would pay your Microsoft revenues so much, and or your Slack revenues, etc. Just keeps on going month on month, and just securitizing those SaaS revenues is something where a lot of people invest now in. But irrespective of the asset class that you invest in, I would still stick to Firoz's point that there is so much of excitement in just equities and just finding value stocks to invest in, which makes sort of finding alternative investment moot unless you yourself are interested in them.
Any sense of the HDFC Bank merger? Any of you gentlemen would have a view on that? What triggered it? What was the grapevine on that? Any insights would be welcome on that. HDFC Bank merger. That's the last question we have. Okay.
As an investor, I did not get it right. So maybe Feroz can help all of us better.
No, Kapil sir, but yeah, not so qualified to comment. But I think this is, of course, very beneficial from the borrowing cost of HDFC, which was the holding company's perspective. So this is the first of its kind. So what triggered this, I would not be able to comment, to be honest. But I think it's a very, very good precedence from an Indian capital market perspective. And it is for an HDFC limited shareholder, it's a very, very big advantage and a long-term big advantage. Not so much from the HDFC Bank standpoint.
Okay. Then I think we have really had a really insightful session, and all of you just made it into another level itself. Thank you all so much for coming in, and I would request Jain University professor to kind of give a vote of thanks. Otherwise, I could do it. Thank you, Mr. Kapil. Thank you, Mr. Shivam. Joel, it was a pleasure. And Feroz, of course, you came in late, but then you hit a few sixers out of the park. It was very insightful to talk to all of you gentlemen. No problem, we understand. It was real pleasure for me. I got to learn a lot, and I hope all of you had an interesting and wonderful time, and the questions that were raised here whet your appetite to learn more about finance, to get into this this noble profession, I would call it, of making demand and supply possible, because finance serves that purpose. It props up the demand curve, it props up the supply curve. At the bottom of it, that is the noble intent that finance intends to bring in, right from the days of the voyagers who wanted to go for a voyage across the seas. Finance has served that purpose, and that's what we are here for today. Beyond all of the things that you hear in the media and all the big bats that finance routinely gets of greed, and greed is good and all of that, at the heart of it is a very noble intent of making things possible for people. People always talk about fire being the greatest invention, wheel being the greatest invention. I humbly submit that the invention of installment payment was a wonderful invention. It allowed us the quality of life that we would never have been able to afford. And so long as you live, please borrow more and enjoy more and pay it back on time. With that, I sign off on this wonderful interaction with all of you.
Thank you so much. It was amazing learning. Kapil, Shivam, Joel. Thank you, Kiran. Bye.
Thank you, everyone. Have a good
Thank you,
day.
everyone.
Thank you. Bye. Bye, Mr.
Bye. Bye.
Bye, Kapil. Bye, Joel.
It's a pleasure, guys. Thank you so much.
Thank you.
Bye.
A big thank you to Mr. Kiran Bindu and all the panel members for taking time out from their busy schedule and sharing with us their valuable expertise. I now request Dr. Renu Rathi, Associate Professor, School of Commerce, Jain University, to read the report of the 5-day interactive global summit on global securities market, the changing landscape.
Thank you, ma'am. Hello, and a very pleasant evening to all the participants on this virtual platform. Wise spending is a part of wise investing, and it is never too late to start. Ronald Karts. I, Dr. Renu Rathi, take this privilege to submit the summit report of a 5-day virtual summit on global securities market, the changing landscape. Stock exchange provides a singular view of the expected way forward for a corporation and therefore is a barometer of country's economy. Effectively, the stock market is an insensitivized survey of a future expected outcome and provides useful information in complex and fast evolving situations. The stock markets of different countries have responded differently to the impact of COVID-19. Though the developed countries bounced back, the economic situation deteriorated, indicating a disconnect between the financial markets and the real economy. To cope with this, the stock markets of different countries have responded differently, and the impact of pandemic on markets constituted a real-life stress test for the risk models as margins surged amidst the spikes in the volatility. The new normal creates new operational risks that must be managed on an ongoing basis. With this objective to provide a unique opportunity on what is in store for markets and specific strategies that individual investors can adopt, regardless of whether the stocks are headed up, down, or sideways, the summit was a great attempt to address the issues of investment in financial markets in a pragmatic and research-driven approach by organizing workshops, seminars, panel discussions, and presentations by experts in this field. Organized by Faculty Research Cell Samshodhana, School of Commerce, Jain Deemed to be University, Bangalore, in association with Stock Market Institute, Bangalore. SMI introduced an app-based learning platform, which is a one-stop solution for all the financial learning, Indian and international qualifications and certifications. StockBite will give access to the world of finance learning through one click. The 5-day virtual summit began on 4th April with a welcome address by Mr. Kishore B.S., founder SMI. In his address, Sir welcomed the participant and shared that this is the opportunity to know what is happening in the world financial markets comprising of stock, bonds, including cryptocurrencies. He introduced his app-based learning as a value addition to the summit, wherein all the registered participants will learn capital market courses from basic to advanced levels with an array of learning topics related to debt, equity, commodity, currency markets, and personal finance. At 6:45 p.m., there was address by Honorable Vice Chancellor Dr. Raj Singh. In his address, Sir admired the theme of the summit being contemporary in nature, and Sir took us back to 1990 when the automation of stock exchange was adopted but was widely opposed, and in a couple of years from then, almost every stock exchange was automated. Sir threw light on three important things in Indian context, which is unique identification number, Jan Dhan Yojana, and digitization of banks in India. Evolving ecosystem and incorporation of blockchain, MI, and AI will have predominant roles to play. Security prices reflect all that is happening in other countries, so every investor needs to be aware of happenings around the world, were the concluding remarks of Sir. At 7 p.m., there was a session on multidisciplinary approach to crypto market by Mr. James Woods, CMT, CFTE crypto market analyst for Bloomberg Intelligence and board member with the CMT Association. Sir introduced a CMT program, that is a program for technical analysis, risk analysis, systematic trading, and so on. The agenda of the session was mental model, applied analytical framework, and Ethereum. He gave 5 analytical approaches for investing in crypto markets: macro analysis, commodity analysis, network analysis, equity fundamental analysis, and technical analysis. He explained the equity analysis of Ethereum by dividend yield and buyback methods, and the session was very informative. The day 2, that is 5th April, began at 6:30 p.m., which was the session on commandments of investing by Dr. Prasanna Chandra, Director of Center for Financial Management and author. In the knowledge sharing session by Sir, he explained the clashes between the economy of investing and the emotions of investing. He made the participant know the enemies within the investors like fear, greed, and wrong attitude. Sir gave 7 commandments of investing as: take charge of your investment, start saving early and regularly, know asset classes, focus on asset allocation, diversity, choose between mutual funds and stocks sensibly, and periodically review and rebalance. There were simple steps of decision making for investment suggested by Sir, which if followed can make the investor successful. The session 2 began at 7:15 p.m., which was on green finance by Mr. George Littlejohn from London, UK. Senior Advisor, CISI, and Editor, The International Banker magazine. Sir focused on the dangers of climate change and highlighted Glasgow Financial Alliance for Net Zero Transition Strategy by 2050. He gave insights on aligning investment with ESG and that every financial decision should take climate change into account. Sir emphasized on the role of practitioners in GFRAs and greater public awareness. Information sharing and constant research and development should help bring about the real shift. The day 3, that is on 6th April, began at 6:30 p.m., where the title of the session was The Global Securities Market, The Changing Landscape by Ms. Deena Mehta, MD and CEO, Asit C. Mehta, Investment Intermediaries Limited, and first female member of Bombay Stock Exchange. Ma'am in her talks gave insights on evolution of market, participants, market practices, and took real-life examples of Dhirubhai Ambani, Harshad Mehta, Ketan Parekh to explain the strategies followed by them. She focused on the safety and security of transactions in the stock market despite huge volume of the transactions. Evolution of trade guaranteed funds and online trading system has made FII investments possible in India. Her concluding remarks were, investors win over traders. The session 2 began at 7:30 p.m. on the global securities market, the changing landscape in academic perspective by Mr. Abhilash Mishra, CEO, NSE Academy Limited. The key takeaway from his sessions were to gather the role of academics in helping existing and prospective investors to understand the nuances of the market. He laid stress on the role of data to understand the depth of the market and fintech applications, which has made the working easier and smoother for everyone. The academic interventions have strong impact on community and society. The day 4, that is 7th April, was related to research paper presentations, which was well received by enthusiastic participants. It was chaired by Professor Sunita B.K. and Dr. Sharmila A. and was coordinated by Dr. Vidya. The last day of the summit was panel discussion. The topic for the panel discussion was Global Securities Market, the Changing Landscape. The panelists were Mr. Firoz Aziz, Deputy CEO, Anand Rathi Private Wealth Management, Global Honorable Member BFSI, Community TEDx Speaker. Mr. Joel Pennicoat, Head Asia Pacific at CMI, Associate. Mr. Kapil Dev, Chief Business Officer, NCDX. And Mr. Shivam Nayak, Founder of L4Zin IIM, Kozhikode. The moderator for the session was Mr. Kiran Bindu, Professor in Finance at ISBR. Ms. Kiran sir began with introducing all the panelists and raised the first question on American inflation and what is expected to happen in the stock market, commodity market, and the startup world. Kapil sir responded to it by saying that there is high volatility in the market and food security will be of huge concern. It will have a long-term impact with great surprise in the market behaviors. Mr. Shivam added to it by saying that there is a lot of liquidity in market and the fiscal stimulus has given more money in the hands of the investor and capital market. But inflation at 7% level will squeeze in the liquidity. It will be a sudden, so regulators need to soften the blow. Mr. Joel added on trend reversal and agreed with the Kapil sir. He added that retail participants have increased, so it needs to locate how retailers can be retained in the market under the current situation. The next question on startup management was taken up by Shivam sir, and he told that India is warming up and markets have shown resilience and due diligence is a must to cope up with the situation like this. On the question related to the skills that the student should take up to be a successful technical analyst, Mr. Joel added that they should learn technical analysis in depth and programs like the programs by CMT can help us to manage the risk. Mr. Shivam on the behavioral finance explained that it is not about the following a path. It is finding out your own strength and play to its fullest advantage. Mr. Kapil added by saying that commodity trading has to be practiced, it has to be traded and learned. Risk management should be a policy and there should be a filtration of information. Mr. Firoz was asked about the secret of his portfolio, and according to him, volatility is the biggest advantage in the Indian markets. Debt should be mixed with derivatives to get the desired outputs. He well explained this with the example to gain advantage in the market. On the issues related to accounting distortion, Mr. Firoz laid stress on improving the governance issues to go with C-score and Z-score, which can help to estimate what are the scores for the accounting companies and what accounting innovations are taken up by the companies. Shivam sir added on creative accounting and stated that due diligence has no substitute. Mr. Joel on the disconnect between charts and price said that technical analysis is a tool to navigate between, but the market risk has to be managed, and at times of frauds, it should be focused and it should be taken care by the analyst. Kapil sir again emphasized on the risk management policy by the regulators to judge the market with leverage, and commodities are sensitive, but they depend upon how active and proactive the participants are and what they can take up. Mr. Joel on chart pattern said that he needs the equity curves to be studied because it keeps him awake at nights when he has to think about the equity curves. Mr. Shivam, the investor in startup, when he was asked the question, not what keeps you awake at night, then he said that betting on the right deal is what keeps him awake at night. Mr. Feroz told that he would be vigilant about the earnings. The four panelists responded to the queries of the participants, and the concluding remarks were offered by Mr. Kiran Bindu, and he thanked the eminent panelists for having spared their time on the evening to be part of the discussion. The summit would have not been possible without having constant support and guidance of Summit Director, Dr. Dinesh Nilkant Sir, and the organizing committee comprising of Mrs. M. Nilima, Dr. Smita Kavtekar, Dr. A. Sharmila, Dr. S. Murlidhar, Dr. Vidya Chandrasekhar, and Dr. Y. Fatima. We acknowledge Mr. Abdul Seth, Mr. Kishore B.S., and Ms. Victoria from SMI and Stock Buy team for their support and cooperation in making this event a success. The event was well received by participants and delegates from different institutes, and the event was live on YouTube each day. Investing puts money to work. The only way to save money is to invest it. Grant Cardone. With this, I conclude my summit report and hand over the session to Mrs. Vandana Talreja. Thank you, everybody.
Thank you so much, ma'am, for giving us a brief insight about the 5-day Global Summit report. Thank you once again. Our Honorable Pro-Vice Chancellor, Dr. Ishwaran Iyer, could not be with us here on this virtual platform this evening. Sir has sent his best wishes and regards for the Global Summit. On behalf of the Faculty Research Cell Samshodhana, Jain deemed to be university, in association with Stock Market Institute, Bangalore, I deem it my honor to have been asked to propose the vote of thanks. I would like to extend my heartfelt gratitude to all the principal officers for their endless support and guidance in the execution of this 5-day Global Summit. I may like to express my sincere thanks to the Stock Market Institute for their constant support in organizing this event. My deep sense of appreciation to all the speakers who took time out from their busy schedule and gave us profound insights about their area of interest and expertise. I would also like to place on record the enormous cooperation of the heads of various departments, coordinators, and my fellow colleagues. I also wish to express my heartfelt thanks to the organizers of this summit for their endless effort and for all their endeavors in making this event a grand success. Last but not the least, a big thank you to all the participants for their active participation. Thank you all. Have a pleasant evening. Participants, please note, the feedback link is posted on the chat box. Do not forget to fill the feedback form. For those of you watching live on YouTube, the feedback form is in the description part. Please fill the feedback form before we end this session. Thank you all once again for your active participation. Have a nice day.